By the end of this video, you'll know exactly how confirmation bias silently drains money from your portfolio and 3 specific things you can do about it starting today. The third thing I'm going to share might change how you think about every investment decision you make from now on. So sit back, grab a drink, and let's get into it. Here's a scenario that plays out every single day on Wall Street and Main Street alike. An investor finds a company they like. They dig into the research. They feel good about it. So they buy in. Then something interesting happens. They start seeking out news articles that confirm why they made the right choice. They scroll past anything that contradicts that view. They rationalize warning signs. And when the stock eventually drops, they're blindsided. Sound familiar? That's confirmation bias. It's the tendency to search for, interpret, and favor information that confirms your pre-existing beliefs. And in investing, it's absolutely devastating. Here's a study that proves it. Researchers at the University of California, Berkeley tracked 10,000 brokerage accounts over a 10-year period. They found that investors were 40% more likely to seek out information that confirmed what they already believed about a stock than to look for contradictory evidence. Even when bearish reports existed and were readily available, most investors never accessed them. And the result? Underperformance by roughly 3.5% annually compared to a simple index fund. 3.5% every year for a decade. That data, published in the Journal of Finance in 2022, shows exactly how expensive this blind spot becomes over time. So here's the first thing you can do about it. Start with opposition research. Before buying any stock, ask yourself, what would make this investment fail? Then go find that information. If you can't find it, that itself is telling you something. If you can find it and the bull case still holds, you've just built real conviction. If you find it and the bear case is stronger, you've just saved yourself from a costly mistake. Warren Buffett's partner, Charlie Munger, called this inversion. You think you want to buy a stock, so you first ask, why would I absolutely not want to buy this stock? It feels uncomfortable. It feels backwards, but it's exactly what the best investors do, and it works. Now here's where it gets more interesting. In 2019, a financial data firm called Refinitiv analyzed 300 million social media posts and compared them to actual stock movements. They found something striking. 92% of retail investor posts showed signs of confirmation bias. Investors were celebrating wins, sharing news that supported their positions, and completely ignoring anything that challenged them. But here's what really stood out. The accounts that showed the most confirmation bias performed the worst. Not just slightly worse, dramatically worse. One investor in their data set posted 47 times about a semiconductor stock in just 90 days. Every single post was bullish. Not one mention of supply chain concerns or valuation multiples. 6 months later, the stock dropped 38%. The posts are still there archived as a perfect record of what happened. This is how it works in practice. It's not that these investors were stupid. They were just human, and humans are wired to protect their beliefs. Here's the second strategy, and this one's about the environment you surround yourself with. Curate your information diet like your returns depend on it. Mute or block analysts and media personalities who only tell you what you want to hear. Actively seek out at least one source with a genuinely opposing view. It doesn't have to be a perma-bear. It just has to be someone who will push back on your thesis before you've committed money. Financial journalist Nir Kaisarian studied this phenomenon for Bloomberg. He found that investors who deliberately read dissenting opinions before making major decisions made better choices. Not fewer decisions, better ones. The goal isn't to become paralyzed by doubt. It's to stress test your thinking before the market stress tests it for you. If this is clicking for you, hit subscribe. I've saved the most powerful insight for last, and it's something most people never even think about. Okay, this is the one I've been building to. Goldman Sachs published research in 2023 analyzing 20 years of trading data from retail investors. They found that individual investors were 6 times more likely to trade after receiving good news about a stock than after receiving bad news. 6 times. Think about what that means. Confirmation bias doesn't just make you ignore bad news. It actively pushes you to act on good news. And that creates a specific pattern. Investors overtrade when things look bright and underreact when warning signs pile up. The trap is that good news feels like permission to act. Bad news feels like something to endure until it passes. But if good news confirms your bias and bad news contradicts it, you'll systematically buy high and sell low. That's not an investing strategy. That's an expensive psychological trap. Here's what actually works. Create a rule. Good news is never a reason to buy. It's a reason to research more. Bad news is never a reason to sell. It's a reason to evaluate more honestly. Vanguard published a study in 2021 showing that the average investor underperformed the market by 1.8% annually over 20 years. One major reason, reactive trading based on emotional responses to headlines. Confirmation bias isn't going away. It's baked into how humans think. But now you know the 3 ways to beat it. Start with opposition research before you buy anything. Curate your information diet to include dissenting voices. And never let good news be the trigger that makes you act. Those 3 steps alone could save you thousands over your investing lifetime. Maybe more. If this video gave you something useful, hit like, share it with someone who needs to hear it, and subscribe. I put out videos like this every week. Practical investing insight that actually moves the needle. See you in the next one.